But what happens if one bank gets in distress? They don't want to sell the buildings, but they have to. Or they don't want to sell the mortgages or loans, but they have to because they're in distress. It's a fire sale. Well, that's when you see real pricing. That's when you see prices down 40%, 50%. But the impact of that on all the other banks is now they count and say, hey, that bank across the street, they just took a $5 billion write off on their commercial real estate portfolio. What about you? You can't tell us that all this stuff is worth par. And then the write downs begin, and then the distress begins, then the fire sales begin, and then that's when the whole system starts to implode.
The COVID-19 pandemic upended the use of commercial real estate around the world, and experts believe a silent crisis is brewing in the $20 trillion sector. During a recent interview with Bloomberg, billionaire real estate investor Barry Sternlicht predicted $1 trillion of losses on office properties alone. Over $900 billion of commercial and multifamily real estate loans will mature in 2024, another hundreds of billions next year. As these loans come due, borrowers may have no choice but to refinance at much higher interest rates or sell their properties at a big discount. Refinancing in a high-interest rate environment is out of the question for many borrowers, most of whom are used to the zero-interest rate environment. A Manhattan office building owned by Blackstone Incorporated is currently being marketed at a roughly 50% discount. In December, Aon Center, the third tallest tower in Los Angeles, was sold for $147.8 million, about 45% less than its purchase price in 2014. The story is the same in many other parts of the country, as well as in cities across Europe and Asia. However, the problem is worse in U.S. cities, which have seen particularly big declines since the pandemic. This is why popular lawyer and investment banker Jim Rickards warns that the commercial real estate crisis will cause the biggest collapse in the history of the U.S. banking sector. We will present clips from Jim's recent interview with Rock Solid Investing, in which he makes some very gloomy predictions for the U.S. banking sector and the overall economy in 2024. Please ensure you watch this video to the end, give it a thumbs up, and subscribe to the channel for more content like this. You can also turn on the notifications bell to be instantly notified whenever we upload a video. Thank you, and enjoy the video.
That work from home thing actually worked. I'm not in Australia, you're not in the United States, but we're doing a face-to-face interview. People got used to Zoom, they got used to teleconferencing, etc. And a lot of people never went back to the office. And then a lot of employers allowed it. I mean, the federal government, all those buildings in Washington, D.C., they're 2/3 empty. Everyone's working from home in Virginia. So that's by itself would have killed commercial real estate. But coming out of the pandemic, when interest rates were quite low at the time, there was a building boom. The developer said, hey, interest rates are 1% or 1.5% or 2% or whatever. Get me a construction loan. Let's put up a skyscraper, et cetera. So you had a building boom at the same time. You had a cultural shift that, in my view, will last for 30 years. And I said that in my book, The New Great Depression. I said, the pandemic may be over, but the pandemic effects, the social changes will last for 30 years, as was the case in the Great Depression. When you have a social shock that significant, you don't get over it in 2 years. So between work from home and the building boom, now there's a glut of commercial real estate, and construction loans are not long-term mortgages. They're like 3-year loans. And you have to, basically the idea is you get a 3-year construction loan, then you lease up the building, and then you get a long-term mortgage, or you get a syndicate of investors and pay off the construction loan and, live off the rents. But they're at the point where they can't pay off the construction loans because the buildings are not leased up. Maybe in Dubai, but not in New York, and I doubt it's any different in Melbourne or Sydney. So we're looking at a commercial real estate collapse. Now, there's a game that goes on where the banks, they just hold it on, the lenders hold it on their books. If you don't sell it and you don't get it appraised, an accountant will let you keep it on your books at, whatever the cost was, the historic value. But what happens if one bank gets in distress? They don't want to sell the buildings, but they have to. Or they don't want to sell the mortgages or loans, but they have to because they're in distress. It's a fire sale. Well, that's when you see real pricing. That's when you see prices down 40%, 50%. But the impact of that on all the other banks is now they count and say, hey, that bank across the street, they just took a $5 billion write-off on their commercial real estate portfolio. What about you? You can't tell us that all this stuff is worth par. And then the write-downs begin, and then the distress begins, then the fire sales begin, And then that's when the whole system starts to implode. So we're right on the brink of that. But that will, again, forget home mortgages. That's the last war. This new war is commercial real estate. So take everything I just said about commercial real estate and combine it with what we talked about the Eurodollar market and what's considered good collateral and the reduction of derivatives books and bank balance sheets. And you've got a very potent cocktail or explosive, if you will, where that's going to basically put us on the edge, if not into a major banking crisis.
During the interview, Jim talked about the 2023 US bank failures. According to the renowned investment lawyer, the collapse of Silicon Valley Bank, Signature Bank, and First Republic Bank within a few days is only a tiny sign of what's to come. Jim reckons we are only taking a brief pause before the crisis returns in full force. When it does, the investment lawyer predicts it will easily surpass the carnage of the 2008 Great Financial Crisis. But the worst thing about the coming crisis, Jim explains, is that the Federal Reserve and the Federal Deposit Insurance Commission are out of moves. They have been expending a lot of resources to prevent the crisis since they announced the Bank Term Funding Program in March 2023. Now Jim says they are out of rabbits and have nothing left to pull out of the hat. Let's get back to the interview.
My experience was that severe banking panics, either monetary banking crises or financial crises, they can be different, happen in two stages with what I call a halftime. So I'll give you a couple of real quick examples. We all remember September 1998, that was the height of the long-term capital management. Russia defaulted in August. Long-term capital management was rescued in September, but if it hadn't been rescued, they would have sequentially closed every market in the world. I mean, we saw that happening. But that started in June 1997 in Thailand when they devalued the Thai baht and put on capital controls. And then it spreads, your neighborhood, Shay. This is spread to Malaysia, Indonesia. Then there was a big blow up at the Hong Kong IMF meeting with George Soros and Dr. Mahathir, my friend, Tun Mahathir. And Bob Rubin had to come in and break up the fight. And then it spread to Korea, and there was literally blood in the streets. People were getting killed in riots, money riots in Korea. But then it calmed down. This was all from June to around September, October. But then November, December, January, February, on into early 1998, it was very calm. Everyone said, well, glad that's over. But then beginning in April, then peaking in September, it came back again. Same thing in 2007. I mean, remember March of 2007, when HSBC announced that their mortgage losses were higher than expected and earnings were disappointing, et cetera. And Ben Bernanke was quoted on the record saying, no problem, this will blow over. And then August 2007, Jim Cramer's famous rant on CNBC with Aaron Burnett, they know nothing, they know nothing. He was right, by the way. They didn't know anything. They never did. But then it calmed down. September, Hank Paulson had the super sieve. We're going to buy up all the credit card receivables from all the banks. It never happened, but just saying it calmed people down. And then in December, this is the funniest part. In December 2007, they called up all the sovereign wealth funds, and they got them to buy 9%, between 5 and 9% of all the big banks. So Kuwait, Abu Dhabi, Government Investment Corporation of Singapore, and a few others. They went around and they bought between 5 and 9% of Morgan Stanley, Citibank, a couple other banks, and they kept offering to buy Lehman. South Korea was going to buy Lehman Brothers. The problem with Dick Fuld is they kept sending the ambulance, and he refused to get in. He didn't understand it was over. They were trying to help him, but so all the sovereign wealth funds bailed out the U.S. banks in December. So everyone goes, okay, that's over. Well, it wasn't over. Now it's going to 2008. So there was a quiet period. March, Bear Stearns fails. June, Freddie Mac and Fannie Mae fail. August, Congress bails out Fannie Mae and Freddie Mac. Then September 15th, Lehman Brothers. Then AIG, Morgan Stanley, Goldman Sachs were hanging by a thread. So my point is that started in the spring of 07. It peaked in September, October 08. But there was a quiet period. So the history of crises is that they become acute, steps are taken, they calm down, everyone thinks it's over, and then they come back worse. So I look at March to May 2023 as stage one. I look at the period since then as the quiet period, as I've described it, and I just gave you two historical examples. So we're ready for stage two.
Whether regulators acknowledge it or not, Stage 2 has started. A few weeks ago, New York Community Bancorp reported material weaknesses in its internal controls, booking a $2.4 billion hit to its earnings. The bank's shares took an immediate hit, tumbling 19% in after-hours trading. NYCB's troubles first became known to the public in January, after it revealed an unexpected quarterly loss caused by massive underwater securities and defaults on large real estate loans. The New York-based regional lender has since been stabilized by a $1 billion capital raise. However, regulators have warned that there may be more to come, as the number of problem banks in the United States has jumped by 18% in 2024. Please share your thoughts on the interview and the coming collapse Jim Rickards has aptly predicted. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.